What's up, you guys? Welcome to the Capitalized Podcast, where we help investors build wealth in real estate. I'm your host, Grant Smith, and today we have a spectacular guest, Mr. John Bowens. John is a thought leader in the self-directed IRA space and a real estate investment professional. He's taught over 60,000 investors and is a director over at Equity Trust, and he serves as head of education and investor success. John, it's a pleasure to have you on the show.
Yeah, likewise, Grant. Thanks for having me.
So John, why don't you go ahead and tell us a little bit about your background, how you got into this weird creative space between self-directed IRAs and real estate and everything that goes on with self-directed IRAs.
Yeah, you're right, Grant. It is interesting and creative. I stumbled across Equity Trust in this business model 15 years ago. And prior to coming to Equity Trust, my background was in traditional finance. So I was groomed and I was conditioned to think only down one track, and that is down the track of put money away into an IRA, 401k, or other retirement savings account. And then as far as investing that money, it was almost like saving for retirement was equal to putting my money in the stock market. And so I was conditioned to think that the only way to save for retirement was to work really hard, put away as much money as I can into IRAs, 401ks, Roth IRAs, other retirement plans, and then take that money and put it into mutual funds, or put it in the, as they would call it, 60-40 model, 60% public equities, 40% fixed income securities. And maybe that's worked okay for some folks, but unfortunately, especially in 2022, I have found that it doesn't work for all folks. And I was a real estate minded individual. I worked for a real estate company, and I was watching the founders of this company pay thousands of dollars in taxes when they weren't able to do a 1031 exchange into another building after the sale of one building. And I was also watching them not put any money away into retirement plans. And I thought that was sort of odd. As my background, I studied traditional finance, spent thousands of dollars learning about how to put money away into IRAs and then put it in the stock market. And so I asked them, I said, why don't you have an IRA, or why don't you set up a 401k for the company? And they said, we don't believe in that. And I said, well, why don't you believe in that? And they said, well, we don't believe in it because we believe in real estate. We believe in hard asset investing. They also invested in gold and silver, and which is something that we do here as well at Equity Trust. And so I said, okay, well, I guess that makes sense. And then 15 years ago, I met our founder. His name is Dick Desich, and he's widely known as the pioneer of the self-directed IRA industry. And he became my mentor, and his two sons, Jeff and Rich, they became my mentors as well. And I learned about this whole world of being able to use an IRA or 401k or other retirement plan. And I could actually go out and buy a single family rental property. I can generate income. That income goes back into my self-directed IRA or self-directed retirement savings account. I don't have to pay any taxes. As long as I follow all the rules and the guidelines, I don't pay any taxes. And then if I sell the property, I don't pay any taxes. And like I'm sure a lot of people are thinking about already on the show, they're saying, wait a second, this is too good to be true. Now, some people may have heard about self-directed IRAs and are convinced that you can do it, but they're sure there's a lot of people out there that are probably saying, what's the catch? Or, this must be too good to be true. I was thinking the same thing 15 years ago. I'm thinking, wait a second, there's no way that this is possible. And why have I never learned about this? So, of course, my analytical mind says I can just study this a little bit more. So I go to IRS Publication 590, which is like a 65-page document. I go to the Internal Revenue Code 4975 and Section 408, and I start doing all this research. And then I go to the IRS website, and it says in black and white that you can own real estate in an IRA. But due to the administrative burden, most financial institutions don't allow you to invest in real estate. So then it clicked for me at that moment. I was like, okay, wow, this makes sense. So I've been told all along that I can't invest in real estate with an IRA, or I shouldn't invest in real estate with an IRA. And that was coming from wealth management consultants and financial advisors that have a vested interest in not allowing me to invest my IRA monies into real estate. And so that's when I uncovered this whole concept, and I learned that, hey, yes, you can do this. Are there rules that you have to follow? Absolutely. With any highly tax privileged structure like a self-directed IRA, there's going to be rules that you have to follow. But if you follow these rules, you can leverage compounding interest in the absence of taxation, which is incredibly powerful. For example, I have two clients out of St. Louis, Missouri. They're real estate investors, and They set up self-directed IRAs back in 2010, and they referred to themselves as stock market refugees. And in 2010, they rolled over their 401ks into traditional IRAs, and then they converted those to Roth IRAs. And they've done over 20 real estate transactions, and they have over $1 million in properties in their Roth IRAs. And they're generating $130,000 every single year in net tax-free cash flow. That's cash flow that they'll never pay a single dime of tax on because it's in their self-directed Roth IRA. All of the income is tax-free. If they sell those properties, they have 14 cash flowing properties. If they sell those properties, there's no long-term capital gains tax. There's no recapture depreciation. There's no long-term capital gains tax on any of those investment returns. It flows back into the Roth IRAs. And then if they want to leave it to their children or grandchildren, they can leave it to their children or grandchildren, and they don't pay taxes either. I'm getting a little bit ahead of my skis here, Grant, but I'll say that from a legacy planning and estate planning perspective, Roth IRAs can be incredibly powerful. So I know that was a bit of a lengthy introduction, but I think it's important for viewers to understand and your listeners to understand the concept of using a self-directed IRA and this whole notion of compounding interest in the absence of taxation. And what that allows us to do is eliminate the variable of taxation. And if we eliminate the variable of taxation, we can effectively get to our retirement goals and our financial goals in a shorter period of time. That's what I learned from Mr. Desich 15 years ago. That's what kept me coming back to this whole concept, investing in real estate myself with a self-directed IRA. I'm also a private money lender with my self-directed accounts. And I've been teaching investors over the last 15 years how to do this as well. So, again, Grant, happy to be here and happy to answer any questions that you or your viewers might have.
Absolutely. And, you talk about, so there's two things that I want to note in your story and how I can relate to them. So when I was going through college, I remember I sat in my first finance class. I'm a finance major now, graduated as a finance major, I should say. And so I remember the first time I learned about compound interest and got to use my financial calculator. And I remember sitting there and just playing with all the numbers and going like, how is everyone just not infinitely wealthy? And I asked my professor that, and he's like, turns out saving money is a lot harder than it looks. And earning after tax returns similar to the ones that you're putting in your calculator are pretty hard too. And so with that in mind, my whole studies in school were about, does anyone outperform the S&P 500 over, a long period of time? And just knowing that, you're coming from the financial industry where, in terms of like tax mitigation, it might be like, okay, us trying to avoid transactional costs and, or I should say like, avoiding, transactions that would create a taxable event, or tax loss harvesting and things like that. Whereas self-directed IRAs, from your perspective, it's a whole way just to completely avoid that whole process altogether and get access to an asset class where you can earn outsized returns at, or maybe more stable returns at, a lower risk profile. And so that's what gets me so excited about speaking with you. But for, simplicity's sake and getting the conversation just started, why don't we talk a little bit about what equity trust is, how it's different from a Vanguard or Fidelity that maybe more people are familiar with?
Yeah. So equity trust is a directed IRA custodian. And what that means is we allow our customers to be in full control and take control of their retirement savings accounts, investing in what they know, understand, and they trust. And in many cases, it's real estate, but you will find that folks can use their IRAs, 401ks, other retirement plans to invest in a wide array of other non-stock market based, also known as alternative assets. So when you hear alternative investments, just think alternative to the stock market. That could be real estate, that could be private equity, that could be private startup companies, that could be gold and silver, physical gold and silver, that could be even digital assets like cryptocurrency. But as far as real estate is concerned, single family rental properties, commercial real estate partnerships, private real estate investment trusts, land. I've seen a number of investors over the last couple of years, especially as a hedge against inflation, using their retirement dollars and investing in land. And the idea is just to allow that land to appreciate. Hopefully it does, and then eventually sell it for a profit. And then outside of physical real estate, private money lending money secured by real estate to other investors. That could be short-term or maybe even longer-term loans. But as far as equity trust and how we are different than another financial institution that is a custodian for IRAs. So most firms out there, they will only custody specific types of assets. In most cases, they're stock market type assets or assets in the fixed income securities marketplace. So most financial institutions, you open up an IRA, you might be able to self-direct that IRA, but you're only going to be able to self-direct it into usually mutual funds, ETFs, exchange traded funds. You might be able to pick individual stock positions if it's a truly self-directed brokerage trading account. But by and large, you're not going to be able to buy real estate with that account. You're not going to be able to invest in private money loans. You're not going to be able to do trust deeds and mortgage notes. You're not going to be able to invest in private startup companies. And a lot of people ask me, John, why is that? Why don't these big shops out there that have trillions of dollars? So we have over $40 billion in assets under custody administration. And a lot of people think that's a large amount because it's one of the largest, if not the largest, in the alternative asset IRA industry. But these other firms, they have trillions of dollars under custody. And most of those assets are traditional investments. And a lot of people ask me, John, why is that? Why won't they hold real estate for me? Well, a lot of them, they don't know how to do it. Their infrastructure isn't set up to do it. And that's by no means any discredit to those companies, because I think a lot of those companies are doing, great things for their customers in other ways. But they're not set up, and their core competency is not alternative assets in IRAs. Whereas equity trust, our company founders, the Desich family, many years ago, they made the decision that we don't want to become the next big brokerage house and just custody traditional assets. We want to help customers invest in real estate. So their philosophy was, instead of investing on Wall Street, invest on Main Street. And that's what our customers have been doing for the last, call it, over 4 decades. In fact, Mr. Desich put together one of the very first real estate transactions back in the early 80s. There were 22 IRA investors invested in a commercial real estate project, and they each invested about $6,000. And over 19 years on a triple net lease, and after the sale of that property, they made nearly $200,000, each of those 22 IRA investors. So that was kind of the flagship transaction, Grant. I mean, that was a lot of years ago in the early 80s. That was well before, I was even in existence, even thinking about this type of stuff, right? And, fast forward now, and we have over 130,000 customers in all 50 states. And I think it's also important to mention that a self-directed IRA it's an industry term. It just indicates to you that you have the ability to take control. And a lot of people can get caught up in the nuances of this, and even in some cases be misled to think that if they roll over or transfer their existing retirement money into a self-directed IRA and buy real estate, that there's going to be some sort of adverse tax consequences or penalties. That's absolutely not the case. So if you have a 401k, you leave your employer, you roll that money over into a self-directed IRA, no taxes or penalties. You go out and buy a piece of real estate. There's no taxes or penalties. So as long as you do it the right way, and then cash comes back in from the rental or sale and you don't pay any taxes. So it's as simple as that. And I think it's really important for people to know that when you're buying real estate, it's no different than if you were to buy like a stock. So we're all conditioned to buying stock in mutual funds with IRAs. They're sort of synonymous with one another. Even though an IRA, you don't invest in an IRA, you put money into an IRA, which is basically like a bank account, and then you invest in mutual funds. So we don't invest in an IRA, we put money in and we invest in an asset. So when we buy a stock or mutual fund, cash leaves the account. In return for that cash is a stock certificate. When we buy real estate, it's the same concept. Cash leaves the account. In return for that cash is a deed to a property. And why a lot of investors are very attracted to this that I talk to is because their IRA, it's tied to a hard asset like real estate. They have a deed, or maybe they're private money lenders. And so they're making a loan secured by the property. So they have a hard physical asset that they can touch, they can see, they can drive by. Or maybe it's physical gold and silver that they're going to store at a depository. We find a lot of investors are interested in that. So when people ask me, John, what is it that you actually do? we do help people get to their retirement goals and their financial goals in a shorter period of time because of these tax efficient IRAs. That's all because the customer is doing some work and investing in what they know, like, and understand and trust. And then B is investors having the ability to allocate a percentage of their portfolio or their entire portfolio into hard assets, land, real estate that's generating income, real estate partnerships, private money loans secured by real estate, and gold and silver, other types of tangible assets. And so those are the two main reasons why I see folks attracted to this model, where they can go from that 60-40 model and instead maybe it's 60-20-20, or maybe it's 90-10, or maybe it's 95-5. The good news is you, Grant, and any listener on this call gets to make that decision on how they can invest their own money. And they're not at the mercy of a financial advisor or financial planner to tell them where to invest or dictate exactly what the right diversification strategy is for them.
Yeah, there's so many good nuggets in there. And I think, for someone, especially who's just getting started, a few key points that, and you correct me if I'm wrong. Number one, you get access to a much wider variety of assets that you can invest in. That's the first thing. But number two is, it doesn't have to be your whole investment thesis, right? You can take off, or you can take part of your retirement funds through your 401k and roll it over into a self-directed IRA, or part of the funds that are in your IRA or Roth IRA and roll those over into your self-directed IRA. In terms of getting funds into these accounts, I know there's transfers and things that you'll be communicating with both financial institutions, but maybe talk about, are there some more advanced strategies that you've seen people take to get additional funds into these accounts, whether it's like a backdoor IRA, Roth IRA, or something like that?
Yeah, I'm glad you brought that up, Grant. The backdoor Roth IRA, very powerful, something that I think everyone should know about, whether it applies to them or not right now, because it may apply to them in the future. So there's two different types of accounts. There's a tax deferred account, which typically you're going to hear traditional IRA. And then there's a tax-free account known as a Roth IRA. So traditional IRAs, that goes back to 1974 when the Employee Retirement Income Securities Act was passed. Most people are familiar with the traditional IRA because they have 401ks or 403bs or thrift savings plans. They have other tax-deferred accounts. And what they do is they roll that money over into a traditional IRA, which is tax-deferred. And what that means is when the money went in, you got a tax deduction for it. And then the growth is tax deferred. So you don't pay taxes as long as you're following the rules. You don't pay the taxes each year as you generate profit. So for like real estate, for example, you have rental income coming back in and you're not paying taxes on that income. It's not until you take the money out of the traditional IRA after 59.5 that you pay taxes. So if I grow a traditional IRA to $1 million and I take $100,000 out when I'm 59.5, I'm going to pay taxes on that $100,000 just like any other ordinary income. So if I'm at a 20% tax rate, I'm going to pay $20,000 in taxes. I get to keep the remaining $80,000. Compared, in contrast, you have a Roth IRA. A Roth IRA, you seed the account or you fund the account with after-tax money. So when the money goes in, we don't get a deduction. It grows tax-free. When we take the money out of the Roth IRA, we pay 0% tax. So as long as we follow the rules. So the Roth IRA can be incredibly powerful. I mentioned a couple out of St. Louis, Missouri, a few moments ago. They have $130,000 coming in every year into their Roth IRAs. They're over the age of 59.5, which is the qualified retirement age. So every year, if they want to, they can take a distribution. They pay 0% tax. Now, their interest is leaving that Roth to their children, or if their children have children, they can leave it to their grandchildren, because they can leave the account to their children or grandchildren tax-free as well, because it's in a Roth IRA. Now, to your point, Grant, the Roth IRA is an incredible financial instrument, but a lot of Americans have been told for a lot of years that they don't qualify to contribute to a Roth IRA because they make too much money. There are these rules, they're called MAGI rules or MAGI limits, modified adjusted gross income. So for example, Grant, let's say you're married filing jointly and you make over $218,000. If you make over $218,000, you're not going to be able to make a full contribution to a Roth IRA. Then you get to a point, which is actually $228,000 for 2023, that you can't contribute at all to a Roth IRA. That's if you're married filing jointly. If you're single, those limits are a little bit lower. And for folks that need to know, you can talk to your CPA, tax preparer, or go to the IRS website and you can look up these rules. It's easy to find. So for all intents and purposes, if you make too much money, you can't contribute to a Roth IRA. So what are your options? Your option is a backdoor Roth contribution. It's not a legal term, it's an industry term. So here's what you do. You contribute to a traditional IRA first, and then you immediately convert over to a Roth IRA. So how much can you contribute every year to an IRA? Well, for 2023, you can contribute up to $6,500 when you're under the age of 50. When you're 50 and over, you can contribute up to $7,500. So every year, you and I, Grant, because you're under 50, I'm under 50, if anyone couldn't tell already. Some people might be, driving and they can't see us, but I do have gray hair, but I'm under 50.
Hey, I do too, and I'm younger than you, so it doesn't discriminate. Age doesn't discriminate.
That's right. It'll accelerate. Trust me. So, right? You're in real estate. You got tenants, right? I mean, it's just what happens, right? So, anyways, you got 6,500 going in, and then you immediately convert that 6,500 over into the Roth IRA. That's known as the backdoor Roth contribution. But that's not going to stop me from taking all my tax deferred money if I want and convert it over to the Roth. Now I'm going to pay taxes on that, but I can do that. A good example of that, Grant, and I'll conclude this segment with this because I think it could be powerful for investors, especially those that are maybe a little bit more established with retirement plans. So I have a client out of Texas. His name's Alan, and he had about $400,000 in a 403B. He was a college professor. And it's like a 401k for people that work for nonprofits. And so he rolled that 403B over into a self-directed traditional IRA. And he went out and bought a property at a foreclosure auction. And he put a renter in there and he started renting it out. And the money was coming back into his traditional IRA and it was growing tax deferred. So he was doing well. He was pleased because he was doing better than what he was making before. But then he thought, you know what? Couldn't I start paying taxes on some of this money and getting it into a Roth IRA and then buy real estate and take advantage of the appreciation and all the cash flow tax-free? So he started converting monies into his Roth IRA, and he didn't do it all at one time because if he converted an entire $400,000 into the Roth, that would be a large tax consequence. So what he did is he converted a little bit of money every year and bought more real estate. So year 2, he converted about $75,000 to his Roth IRA, paid the taxes on that amount, bought a property, paid for the expenses on the renovations, rented it out, and all the money came back in tax-free. The next year came around, he converted another chunk of money, bought another property, cash flow coming back in. Next year, he buys another property. So now he's got 4 properties, 1 in his traditional, 3 in his Roth IRA. The Roth IRA is generating about $33,000 in tax-free profit. And that doesn't include the appreciation of those properties, which has been substantial over the last few years. And he still has that property in his traditional. So he's got tax deferred and tax-free money coming in. And if he sells those properties, he's got no long-term capital gains tax. So his thesis is that he would pay more in taxes in the long term than he would in the short term. So that's the question that folks should ask themselves is, would I pay more in taxes on the seed or more on the crop? And in his circumstance, he felt strongly that he would end up paying more on the crop. So he went ahead and converted the money and paid the taxes. And he spread out his tax burden. That's why he did it over multiple years. So he didn't show one large lump sum conversion. He spread it out over multiple years.
Yeah, that's a great point there. And I think, something to really think about is, if you're converting this money, how can you do that as tax efficiently as possible? And like you said, consulting with your CPA or whoever is your tax professional can certainly help you there. One of the, you've gone through some great examples of, acquiring real estate. Maybe talk about some experience like with you lending your funds, what that looks like, how you work with, how you work with equity trust to, collect interest payments and all that good stuff, and just how it all works on the lending side.
Yeah. So we have a lot of customers that are private money lenders, and they go out and find borrowers or they find companies that sell notes and they connect with them and they make loans. And I think that is important to mention. You asked a little bit about equity trust. We're a directed IRA custodian. And so we don't endorse, recommend, advise. We don't sell investments. What we do is educate, inform, And we offer the custody solutions and the infrastructure and the one-on-one personalized support so people can do these types of things. So they can invest in real estate and private money loans and such. So to give you an example, me personally, as a real estate investor, I go to a lot of real estate investor meetup groups, and I connect with a lot of local real estate investors here in Cleveland, Ohio. And I meet investors who fix and flip properties. And they are always looking for financing, right? Especially right now with what's happening with interest rates. And some of these folks, they could go to a hard money lender, right? And they could be charged, 3 to 4 points, maybe even more, 13, 14, 15% interest, right? Depending on the transaction, which there's nothing wrong with that. Which, by the way, as far as all the hard money lender companies out there and other firms that do that type of business, I respect that. There's a lot of infrastructure and cost involved with that type of operation. And that's why they charge the rates that they do. And there's that there can be value as a flipper to be able to go to those lending sources and quickly access money. But if they don't need to do that, they'll oftentimes try to come and work with an investor like myself, a private money lender. Now, why do people end up going to hard money lenders? Well, there's not enough private money lenders out there. That's just the truth of the matter, right?
Yes.
So if they have an opportunity to come to somebody like me, they're going to have a little bit lower cost of capital. And, they're working with someone that they know, someone that they've built a rapport with. So as a private money lender, I meet real estate flippers, and my self-directed IRA will make a loan to a flipper. And I have an attorney that's drafted a promissory note and a mortgage. And so we have a promissory note and we have a mortgage. So we have a first lien on all these properties we lend on. And as far as mechanically how we do this with our equity trust IRA, is very simple. We have our equity trust IRA opened. You have to have an account open and funded in advance, of course. And then we log into our online portal. It's called My Equity. And we say, equity trust, I want to direct my money to XYZ title company for this private money loan. And we upload a copy of the promissory note and the mortgage. And then equity trust wire transfers the money directly to the title company for closing. So now I have my promissory note signed by the borrower. I have my mortgage signed, notarized, and recorded with the county recorder. So either I have an attorney or the title company handle all that, of course. And then all of the interest payments, if I collect interest payments recurring month by month, go back into the IRA. Or if I have it structured where they're going to make the interest payment and full balloon payment at the term of the loan or when the property sells, then all of that money after closing flows back into the self-directed IRA. So to give you an example, Grant, last year, after I sold a property that was in my self-directed accounts, I took the money from the sale of the property, and I rolled it right into a private money loan with a real estate flipper. And I wrote the loan as a 12-month term loan, charged 13% annum, and the property sold in 8 to 9 months. I made about 9% interest on the transaction. So it was a $100,000 loan. And I actually partnered, this is interesting for folks out there that maybe don't have a lot of money in one or the other IRA. So I had a traditional IRA and a Roth account. I partnered both accounts together to make the private money loan. So I took $65,000 from my Roth, $35,000 from my traditional, partnered the two accounts together to make the private money loan. So it was a 65-35% split. And then when I got my $100,000 principal back, which was just a few months ago, plus the $9,000 in interest profit, that was split up 65-35. So takeaway there is you could actually partner multiple accounts or multiple money sources together to finance these types of private money loans. The $9,000 in interest profit, I paid 0% tax on because it's interest income in my IRA, which is not taxable. Private money lending with IRAs, remember that if you make private money loans outside of your IRAs with your taxable dollars, all of that income is subject to your ordinary income tax rate. So for me, which might be different than others on the call, but for me, my income tax rate is usually 25 to 28% tax. So 25 to 28 cents on every dollar. So had I done that investment outside of my IRA, I would have probably paid about $3,000 in taxes. Because I did it with my self-directed IRAs, I kept that $3,000 in my self-directed accounts. That gives me more investing power to put forward for other transactions. So when I talk about compounding interest in the absence of taxation, that's what I'm talking about. I'm eliminating that variable of taxation. That's ultimately what's helping us get to our retirement goals sooner.
Yeah, John, you are answering so many questions that I have from all the people that have voiced questions. One of them was, hey, I'm a private lender. I want to start, lending, my own funds. But I want to use my loan docs. I don't want to use like loan docs that are going to have to be drafted by, do they have to draft my loan docs for me? It's like, no, they don't, which is what you've conveyed to me. The second thing is about partnering accounts, which was a great question. It's like, well, when I first started working, I just was contributing to my traditional 401k and traditional IRA. I didn't really know about Roth yet or a Roth 401k. And so, I want to be able to, fund entire loans, but I need to use both accounts collectively to be able to fund these loans. And so you answered that question as well, which is you can definitely, fund a hard money loan, or not hard money loan, a private loan with both accounts. To make up the sum of the $100,000, right? $65,000 from one, $35,000 from another to fund the entire loan amount, which is a great question. One of the related questions, and this might be moving more into like the pitfalls, because I'm just not familiar with the regulations surrounding this. Let's say I want to do a private loan, on a residential piece of real estate, fix and flip property. Let's say it's $100,000. I have, $65,000 of Roth money, whether it's a 401k, I've rolled it into equity trust, but that other $35,000 that they're asking for in that $100,000 loan, I don't have any more retirement funds. Am I allowed to use my personal capital, or does it have to be all retirement account funds?
You could use your personal capital, but you have to be careful when you do that. So there are what are called disqualified persons to your IRA under the tax law provisions. So 4975 of the tax code is the specific tax code section. If any viewers were interested in, light reading and checking things out like that, that's a dry joke for all of your listeners out there. But the tax code 4975 says who disqualified persons are, and disqualified persons would include an account owner to themselves, their spouse, their parents, their grandparents, and then their children and grandchildren. So I always like to explain it's anyone up and down the family tree is considered a disqualified person. And then, of course, any businesses that you own and operate combined with you and other disqualified persons are most likely going to be considered a disqualified person as well. It's just an extension of you. And there's some odd rules around 50%, but you don't want to push the envelope on this, because if you do a prohibited transaction, your IRA will be distributed January 1 in the year in which the transaction occurred. So there are these disqualified persons to your IRA, and disqualified persons can't transact. And 4975 breaks down what are transactions. The good news is, Grant, that the tax code and the government, when they created this legislation, they were exclusive rather than being inclusive. So they only tell us what we can't do, not what we can do. And this is where a lot of folks can get caught up, because people tend to look at what you can't do. So there's like, as far as what you can't do, it's like this much. And then there's like, miles and miles of what you can do. And there's very few people that you can't do business with. So it's really only those immediate family members that we talked about. I do have people that ask me, what about brothers, sisters, cousins, uncles, nieces, nephews, people across the family tree? Technically, those aren't disqualified persons. So you got to be mindful of the up and down the family tree disqualified persons rules. And as far as transactions are concerned, you can't buy from, sell from, lease from, you can't provide services, you can't receive any type of personal benefit, you can't lend money. So if I own a property now, I can't get that property into my IRA. My IRA can't buy it from me. I can't buy a property using my IRA money and then rent it out to my in-laws or my parents or my children. Those are prohibited transactions. I can't take money from my IRA and lend it to myself personally. That's also a prohibited transaction. So to answer your question, what you're talking about is partnering with disqualified persons. And the answer is yes, it can be done as long as it's done appropriately. So for example, use 65,000 or 65%. So if I fund a loan 100,000 and I use 65,000 from my Roth IRA, let's say, and then I personally bring in 35,000, I have to make sure that on the promissory note, the lender has equity trust company custodian for the benefit of my IRA and the percentage, and then also me as, in this case, 35%. And then when all the profits and principal flow back in, I have to make sure that those profits and principal flow back in 65-35. And that is exactly what I did on the private loan that I did. In that case, I used my traditional and my Roth, but I could have used my traditional and my non-IRA money, or I could have used my IRA money in my spouse's IRA, or my IRA and a child's IRA. I even had a client here, Grant Stan, who has 10 IRAs and investment accounts for himself, his children, his spouse, his in-laws. And he did a private money loan where he made a loan to a mobile home park operator secured by the mobile home park. And he was receiving interest and an equity participation, and he had all 10 IRAs involved. So all 10 IRAs were on the promissory note and mortgage with their own individual ownership interest. And then when the profits were flowing back in, they were just flowing back in proportionally. So if you're going to partner with disqualified persons, you just got to make sure that everything is done concurrently or proportionally. Now, that does lead me to, what if you partnered with a non-disqualified person? So if you partner with a non-disqualified person, in theory, you can negotiate whatever percentage split you can. So a great example of that is I have two clients that I started working with a couple of years ago, and they're in Dayton, Ohio, and they like to remain anonymous. So I'm not going to say their actual first names because they probably be recognized. But I'm going to say investor A and investor B. So investor A had a Roth IRA, has a Roth IRA still, but at the time, about a year ago, his Roth IRA only had about 13,000 and some change in the account, which you're going to hear this come up all the time, Grant. I don't have enough money in my IRA to fund the deals that I want to fund because people haven't put enough money in their IRAs. That's okay. We understand that. Don't feel like excluded or don't feel like you did something wrong. All right. Because you probably just weren't told about this. So, now is a good time to be thinking about this. So this gentleman had about 13,000 and some change in a Roth IRA, and he wanted to take down, it was about an $80,000 deal, purchase and rehab. And then they planned on selling it in 8 months to a year. He had an investor friend that had money in his IRA. Didn't have to be his IRA, but it just so happened to be his IRA. And he had the money for the remaining amount. So investor A found the deal, put 13,000 and some change in. His investor friend funded the remaining amount. They created a joint venture partnership. And per this joint venture agreement, the investor A was to receive a much larger percentage of the profits because he's the one who found the deal. He hired the contractors. He's the one who sort of administratively oversaw the entire transaction. When it was all said and done, and this deal closed about 2 weeks ago, the wire transfer came back into the Roth IRA in the amount of $47,000 and some change. He made a $34,000 tax-free profit in his self-directed Roth IRA, paid no taxes. His other investor partner got his percentage. He was happy. Investor A was very happy making his $34,000 and paying 0% tax. So that's an example of how someone could actually consider partnering with a non-disqualified person. In the private money lending space, sometimes you hear of wrap loans where you have, one investor with a small amount and then another investor with a larger amount, and the lead investor gets a larger percentage. You could potentially look at doing that with a IRA as long as it's with a non-disqualified person and making some significant profit with a small amount of money in your retirement plan.
Yeah, that is just a phenomenal explanation of how you can quickly grow that account, especially if, like, to no fault of, any of these individuals, it's like they might not have understood these retirement accounts or, how to build them through the traditional means of just, hey, contribute every year. You can expect, returns in between X and Y, probably nothing greater than 10%, depending on what type of selection you're making. And it's just incredible. I mean, 4X, 5X their, retirement account in such a short period of time. That's just a very exciting strategy for people who are looking to quickly build up, how much money they have in those retirement accounts. So I want to, kind of start bringing things full circle here. And I want to talk about, we talked a lot about real estate. There's other assets, right, that you can buy in self-directed IRAs. Maybe just go through some of those, what other alternative investment classes that people are, looking at, and what they can look for when they're, have a custodian or someone like equity trust.
Yeah, absolutely. So you have private real estate investment trusts. That's an opportunity where maybe the investor is a little bit more passive. Maybe they don't have a whole lot of money, but they have an opportunity to put $10,000, $15,000, $20,000 in a private real estate investment trust. That's an option. A multifamily real estate type syndication, we do see those occasionally as well. There are some nuances for investors to work through on those because your IRA is involved in a debt leveraged real estate deal, but that could be done. Land, I suppose that's real estate as well, but just noting that you could buy land. Some people are doing that right now as a hedge against inflation. If you're interested in doing that, by all means, there's nothing against buying land with your IRA. It's not cash flowing, but that's okay. You don't have to have cash flow coming back into your IRA. The plan might be just appreciation. Physical gold and silver. That is a popular asset class amongst many equity trust clients. We don't endorse or recommend when to buy gold or to buy gold. But if you're somebody that is interested in gold and silver, you can buy physical gold and silver with your IRA. In fact, we custody over $3.5 billion in physical gold and silver. The actual assets are stored at depositories. So these are licensed, bonded facilities that specialize in the custody of physical metals, but you can do that. Digital currency, cryptocurrency, we do have a crypto trading platform that is available to our customers if they want to buy certain coins. And you have the entire ecosystem and infrastructure built there to accommodate those transactions. In addition to that, we still do have the infrastructure for folks to be able to invest in traditional assets like mutual funds, stocks, ETFs, bond funds, those types of traditional assets. You can do everything all under one roof. And then last but not least, private placements or private equity, private direct investments, hedge fund type investments. There are certainly opportunities to be able to take advantage of there. A lot of people, when they hear hedge funds or venture capital funds or private equity, they think, well, that's only for the top 1% of folks. Well, what's really interesting, Grant, is over the last 10 years, there has been massive technology development in that space, which has actually afforded the everyday individual to invest in these types of asset classes that only the top 1% had access to for a lot of years. And it really started back in 2013 with the Jobs Act. And then it was about 2015 to 16 that we really saw a lot of these online crowdfunding portals and online platforms start to evolve from a technology perspective and actually open their doors and start bringing in investors. So you think about it, and I believe that there will come a day where people will be investing in private alternative assets, just like they use their brokerage account to buy individual publicly traded stocks and mutual funds and other traditional assets. So I think there's a lot of ways for investors, whether you're a high net worth individual or you're just getting started, even for those that are, maybe a little bit younger in their 20s or early 30s and set up their first IRA and made a contribution. There's actually a lot of opportunities to invest in these types of alternative assets and get to move your money like the top 1% have been moving their money for a lot of years.
So with that in mind, new person getting started with this information, let's say they might have a CPA or, a tax preparer in their corner, but maybe they're not familiar with these products or the strategy. Where can they go to get more education? Where can they go to build, their network of professionals that can assist them with, navigating this world, first and foremost, legally, and then second, successfully?
Yeah. So great resource that we have built for folks that are interested in learning more, as well as our existing clients, is our video channel that we have on YouTube. So folks can go to youtube.com, just search Equity Trust Company. You're going to find lots of video training. These are, non-hypey type videos. These are, this is the facts. This is the information. We're a regulated financial institution, so we take a little bit different approach when it comes to, video content and such. So folks can check that out. They can go to our website, trustetc.com. You'll find lots of information and education on there as well, how-tos, tutorials, guides, things of that nature. So that's a great place to learn more and dig into some more of the details of how all this works.
Spectacular. John, it's been an absolute pleasure having you on the show. You are a wealth of knowledge in this space, and look forward to personally taking action on the information that you provided, and continuing to follow up on the information, all the great education you offer. Is there any place where someone wants to open an account where you would direct them to?
Yeah, absolutely. So if folks go to our website, trustetc.com, or just search Equity Trust Company, you'll find you can call us directly, which is what I would recommend for folks to do, is to reach out to us directly, because one of our agents can actually answer your questions. We're very much proponents of that one-on-one personalized support. Make sure that we understand what you're trying to accomplish and we can provide the right information. We don't sell investments or advise, but we want folks to reach out to us so we can make sure we help guide them down the right path. So an individual can reach out to us. We can help them open their account. When they go to our website, they'll see where they can actually start opening an account right on our website. If they wanted to kind of jump to the front of the line and just get started right away, by all means, they can do that. And it's a fairly simple process to open an account and then transfer your money over. And we help you with that. We have over 420 agents here at Equity Trust, and we're on the phones day in and day out, walking clients through these different processes and procedures. So I know a lot of companies in the financial arena, they kind of want you to go on the website and just do everything on your own. And we take a little bit different approach, because we understand that self-directed alternative asset investing is a little bit more customized and niche. So we offer that one-on-one support for folks that want to reach out to us and get a little bit more guidance.
Excellent. And for anyone who's trying to capture all this information, we'll make sure we put it in the description to either the podcast episode or the YouTube video. And John, thank you so much for coming on.
Thank you, Grant. Appreciate it.